quick question for you. Would you like to stop losing at day trading and instead start performing at a high level? I can help with that. In a recent trading tournament, I made it all the way to the live finals, finishing in the top 1% of traders, and I did it using 3 basic rules that you can start to implement today and stop losing, start trading like you've always wanted to. These 3 rules will keep you on the right side of the market and help you avoid traps almost entirely. And once you really understand them, you will stop losing money where everyone else is blowing up accounts. So if you've ever bought at the top or shorted at the bottom or entered on a breakout just to see it reverse on you, then pay attention. You're about to learn why those trades fail and how to do it the right way. Rule 1 is the trend line rule, which is that a trend is in play until it has had a break of the trend and then a push to a new extreme. We've all heard of trends, and most traders know to wait until a trend is broken before looking for a reversal, but that's not actually when a trend is done. Let's say you have an uptrend here. Most traders are watching the trend line very closely, and once they see a candle breaking out of the bottom, they immediately think, okay, this trend is over, this is the top, it's time to short, we're about to get a drop. But that's not really true. This is actually the point when you should be looking to buy. That's because a trend is created by institutions. They are backed by billions of dollars, and if they're moving the market up, that is where they want to go, and it is not going to typically just reverse right out of the blue. But obviously it does have to end sometime, and the way that usually happens is that there is a break of the trend line. There's almost always one final push up to a new extreme, which in the case of an uptrend is a new high, and then the trend is over and we're likely to reverse. So what should you do instead? Well, first of all, you have the highest probabilities trading with the trend. I know reversals are flashy and cool and everyone wants to be able to trade them. They are just much less consistent. So I always recommend trading with the trend, although this rule will allow you to do both, right? It's identifying when a trend is in play and when it is played out. When it is in play, we only trade with the trend. If you're looking for a reversal, you need to wait until it is played out, meaning that it has had a break and new extreme. And the same is true, of course, to the downside. If the market is trending lower, the first step is to identify the trend, starting at the top where the trend starts, going to the bodies of the candles, and this whole time we would only be looking to sell. That is where probabilities are in our favor, is selling this whole way down until the market has had a break of the channel. We're not buying here, right? Because this downtrend is still in play. Even if we start chopping around a little bit, probabilities are best to short until the market moves to a new extreme. In the case of a downtrend, a new low. That is when we would need to stop shorting, and we would expect the market to then bounce in the other direction. To see how this works in a real life scenario, let's take a look at a chart. Notice how I start the trend line at the bottom wick where the trend started, and I am drawing it to the bodies of the candle of the first swing. We have probabilities on our side. We just want to trade with this trend as long as it is in play, meaning the whole time that we are in the channel until we break out of it and get a push to a new extreme. And especially as we break out, this is where you're going to trap a lot of traders. It is so popular to try to predict when the market is done, when a top is in. There are people shorting this who don't know the trend line rule, who don't know that this thing is still in play. This is just the first break. We are very likely to get a push up to a new extreme. You'll see right here that We could take longs this whole time expecting the market to go up, and look, it is continuing to go up. We just have our high marked out. This is the point of no return. Once we get above that high, it's very likely that this trend is played out, and that happens right here. We finally get a new high after the trend line was broken, and that is when we would need to stop going long and instead start thinking that, hey, we possibly could get a short. This market might reverse soon, and it's exactly what starts to happen here. So to get another example, we can see here that the market is generally going down. So let's see if we can find a trend line starting at the top wick here, and then drawing our channel to the body of the first swing and just extending it from there. So this whole time, the best trading decision we can make is to short. Probabilities are on your side this whole trend down until we have a break in the trend line, which occurs right here. And just like in the previous example, this is where longs are going to get trapped, because a lot of people assume, hey, the trend is breaking, that means we're going to reverse. But in actuality, the more likely scenario is that we push down to a new extreme first, and then maybe we'll get our reversal. So a lot of long traders getting trapped right here. Then the market pushes to a new extreme. And technically it happened right down here. So we would need to stop shorting because the likelihood of a reversal has just gone up significantly. And in this case, it kind of chops around for a little bit, but then quickly starts to reverse. So it's not magic, right? It's not going to happen exactly once it makes that new extreme, but that is your indication, okay, probabilities are no longer on our side to start shorting. And in fact, we would expect a bounce in the other direction. And here you start to get a bounce, and then you just start that process over. Now we have an uptrend, right? And we can start to look to go long this whole time until this thing has a break and new extreme. It's pretty crazy. If you've never seen this rule in action before, start drawing trend lines on your chart and notice how often this happens. Break, new extreme, then reversal. Break, new extreme, then reversal. And now for rule number 2, which is the range rule. And that is, most breakouts of a trading range will fail, at least temporarily. So think about the last time you bought the breakout of a range. It broke through the resistance, you hit buy, and then all of a sudden the market just plummeted against you. Welcome to one of the most common traps in trading. Let's think about why this is the case. When we were talking about trends, we know that institutions are pushing price up, right? If price is trending to the upside, that means that for whatever reason, institutions are valuing that asset at a higher and higher price, right? They want price to go up. But if we're in a trading range, price is not trending, institutions are not really moving the market anywhere. They're accumulating or distributing right around the current price. Essentially, buyers and sellers have paired off, and they have more or less agreed that, yeah, this is where price should be right now. So since that is kind of what they have agreed upon, anytime that price breaks out of that consolidation, it's usually just a way to generate more orders for them to maintain their position around this price. And institutions know that retail traders are going to jump at any signs of movement. So like a big green candle coming out of the top, retail traders are clicking that buy button. That gives them the orders they need, and they can easily fill those and move right back down where they were. So instead of getting trapped like the rest of retail traders, just do the opposite. When price breaks out, instead of buying and thinking this breakout is going to be the start of a major move, fade this move with institutions and ride the wave back into the range. And this rule is pretty easy to see in practice. When the market is ranging, it's very clearly not going anywhere. There's general areas on the chart where price keeps moving back and forth between. Every time price gets down here, it goes up. And every time price comes up here, it goes down, right? It's just pretty clearly obvious We're just going up and down around the same general area. So right here, we can see the price is about to break out of this range. And so you get this candle right here. That's where all the retail traders are starting to smash that sell button. So what are we going to do instead? We're not looking for that breakout to continue. We remember rule number 2, most breakouts of a trading range will fail, at least temporarily. So instead, our probabilities lie in taking a buy, and boom, we get a move right back into the range. Here we are at the top now. Same thing, we're breaking out, right? Look at this big green candle. This is amazing. We're going to start a huge run. But then we remember rule number 2, we're in a trading range. Most breakouts of a trading range will fail, so our probabilities actually lie in taking a short position here. And what do you know? We move back down into the range. And yet again, here we come to the bottom of the range. Oh man, is this going to be a breakout? Look, those candles are down there at the bottom. Where do our probabilities lie? In fading the move. There we go, right back into the range. Now you may be thinking, surely that can't work forever, right? The market doesn't stay in a range. Eventually, that breakout really is going to work. That's absolutely true. So a couple things. First of all, trading is always probabilities, right? There's nothing you can do that has 100% certainty of working. We're talking about what works more than what doesn't work over the long run. So over the long run, more breakouts are going to fail from a trading range than they are going to succeed, right? So we're talking about probabilities. But the second thing is you can actually combine rules number 1 and number 2 to help you figure out when that breakout really is going to break out of the trading range. So we have a trading range here. Now let's remember rule number 1. A trend is in play until it has a break and a new extreme. Even in a trading range, which is no trend at all, right? We're just oscillating back and forth. There are still mini trends that get played out as price is going back and forth. So drawing our channels, we can see that there was a downtrend, a miniature downtrend in this trading range working right here. And this downtrend is in play until it has what? A break and a new extreme. So this downtrend is in play here. It has a break and a new extreme, and we find ourselves at the low of this trading range. So where does probabilities lie? Well, now we have 2 things going in our favor, right? The trend is played out, so we would expect a bounce because of that. And we're at the bottom of a trading range, so we would expect a bounce because of that. So the probabilities unite, and boom, we get a nice move up from the support of the trading range. Now the same thing is true on the other side. We are coming to the top of the trading range, and we can identify an uptrend. That will remain in play until we get a break right here and a new extreme right here. So at this point, in all likelihood, this trend is played out and is going to reverse. Plus, we are at the resistance. This breakout is likely to fail, so our probabilities lie to the downside. And yet again, here at the bottom, we are moving down. So let's draw our channels, and we can see that we clearly have a downtrend in play. Now, downtrend is in play, and we find ourselves at the bottom of the trading range. This means to buy, right? Well, we are at the bottom of the trading range. Most breakouts of a trading range will fail. However, this downtrend is still in play. It has not yet had a break and a new extreme. So at this point, probabilities are a little bit mixed here, and it would be better for us to wait until this downtrend is actually played out before trying to fade the move. And so it looks like this breakout is actually the one that ends up working. But we are able to use rule number 1 to stay out of that one. So very simply, these 2 rules protect us in the 2 main areas that traders blow up. Trying to predict reversals from trades that aren't done yet, and trying to predict breakouts that haven't happened yet. So following them will keep you out of the vast majority of bad trades that traders take. Rule number 3 is the trading plan rule, which is that you need to have a specific plan for every single aspect of the trade you're going to take before you enter. Now, I think a lot of traders get hung up on this rule because there's a lot of talk about like, oh, what size do I need to use? What risk should I have for my account? What's my exact entry and stop? Those are all important questions, but first of all, they can only come after you have mastered the first 2 rules. That's the most important, knowing what the market is doing, where price is likely to go, and what side of the market you should be trading on. If you did nothing else but follow the first 2 rules and only take trades that align with the market direction, you could build yourself an amazing trading career. The trading plan only comes after that. It's after you already know which side of the market has the best probabilities. From there, it's just a matter of making a plan and following through. And honestly, a lot of the specific requirements are going to vary from trader to trader, depending on your account size, your risk tolerance, or your style, whether you like to go for base hits or maybe go for those bigger moves. The most important thing though is that you have that mapped out before you click any buttons. You need to know exactly what you're going to do and what is going to happen to get you to get out of the position or add to it or take a break even. You don't want to just figure that out as you go or make decisions while the trade is happening, because ultimately that will always lead to emotional decision making, which is never a good thing. With all that said, if you do want to know more about the exact criteria that I use for my trades, I cover that in depth in my masterclass, which you can find in the link below. So everything from entries, exits, trade management, even my approach to prop firms, it's all in there basically from the ground up. But the bottom line is this does not have to be overly complicated. Know what the market is doing and where it is likely to go next, and then just build some basic rules for yourself so that you're not trading on emotions. And what I've laid out for you in this video can take you from constantly fighting the market to trading with it. See you in the next one.